What's up, investors? Palantir reported its Q1 2024 earnings earlier this week, and its stock has gotten absolutely crushed since then, down over 10%. In this quick 5-minute video, we'll break down the key numbers, analyze if the sell-off was justified and whether this dip is a buying opportunity. Let's dive right in. Palantir's Q1 revenue came in at $634 million, up 21% year-over-year and beating estimates. Adjusted EPS was 8 cents, meeting expectations. The company generated strong adjusted free cash flow of $149 million at a 23.5% margin. Cash balance increased to $3.9 billion from $3.7 billion last quarter, so the results looked pretty solid overall. Revenue growth was decent, they remained profitable, and the cash position strengthened. But investors were clearly expecting more based on the huge sell-off. The main disappointment seems to be the lack of AI-powered hypergrowth that the market was pricing in. While Palantir's U.S. commercial business grew 40% year-over-year driven by strong AIP adoption, the overall sequential revenue growth at Palantir actually slowed down to 4% quarter-over-quarter, which implies an annualized growth rate of just 16%. During Q1, Palantir added 262 new U.S. commercial customers through 660 AIP boot camps, which is great, but it just wasn't enough to offset the growth moderation in other segments of Palantir's business and drive company-wide hypergrowth. At a premium 76 times forward PE valuation, investors were clearly expecting Palantir's AI capabilities to translate into much higher growth rates, at least in the 30 to 40% range. In today's volatile market, Palantir's recent sell-off has sparked a flurry of debates. Was the reaction of the market justified, or an overreaction to transient issues? Let's delve deeper into the valuation metrics to uncover some insights. Based on our comprehensive analysis, Palantir is currently valued at around $15 per share, starkly contrasting the market price of $23.50. This indicates an overvaluation by more than 35%. Even if we were to assume an aggressive 25 times exit multiple for future earnings, the expected compound annual growth rate, or KGR, over the next 5 years would only be 6.4%. This falls significantly short of the 15% return threshold that investors typically expect from a growth-oriented stock like Palantir. Hence, from a financial perspective, the premium valuation currently placed on Palantir seems difficult to justify unless there's a substantial acceleration in AI-driven growth in the near future. As we analyze the stark contrast between Palantir's intrinsic valuation and its current market price, it's crucial to consider the broader investor sentiment driving these numbers. Recent sell-offs and the subsequent market reactions reveal a deep-seated uncertainty among investors. While some are swayed by the potential of AI-driven growth, others remain skeptical about the tangible outputs and timelines of these advancements. This dichotomy in beliefs has led to volatile swings in stock prices, reflecting a market that is grappling with future expectations versus present realities. In this climate, understanding the psychological underpinnings of investor decisions becomes as important as the financial metrics. Are investors reacting to the fundamentals, or are they being influenced by broader market sentiments and the fear of missing out on the next big tech wave? This sentiment-driven market provides a unique challenge and opportunity for the informed investor. In light of the investor sentiment and market reactions we've discussed, let's delve into how companies like Palantir strategically respond to such volatile environments. Companies often take calculated steps to either reassure the market or realign their strategies in ways that address investor concerns directly. For instance, increased transparency in AI development timelines or more detailed financial forecasts could be deployed to regain investor confidence. Moreover, strategic partnerships or acquisitions might be pursued to accelerate growth or diversify revenue streams, showing a proactive stance against market uncertainties. Understanding these moves provides a clearer picture of how companies not only survive but also thrive in a sentiment-driven landscape. As we wrap up today's analysis, the verdict on Palantir stands clear. Currently rated as hold neutral with a price point hovering around $23.50 per share, the decision leans towards caution. The allure of long-term AI-driven growth remains potent, yet the valuation presents a steep front, deemed too frothy under current conditions. For those eyeing a robust 5-year return exceeding 15%, A price correction or a strategic timing could render Palantir a more enticing prospect. However, at this juncture, the scales of risk versus reward do not tip favorably, especially when the AI hypergrowth premium is stripped away. The counsel here is patience. Await a more favorable market entry point, unless you're prepared for a prolonged investment horizon. Diving in now might resemble trying to catch a falling knife, a risky endeavor that warrants caution and strategic planning. There you have it, folks. A concise breakdown of Palantir's Q1 earnings, and an exploration into whether this dip presents a buying opportunity. As we've discussed, while the potential for long-term growth driven by AI innovations is enticing, the current valuation suggests a cautious approach. Remember, the perspectives shared today are based on current market analyses and are not direct investment advice. I encourage you to share your views on Palantir in the comments below. Did this analysis align with your thoughts? If you found this video informative, please hit that like button and subscribe for more insights into the stock market. Thank you for tuning in, and I look forward to catching up with you in our next video.